Good day and welcome to the last of our five-part series on asset market reviews, and this one dealing with the Korner BCI Flexible Fund. This is really the manager report to the 31st of December 2023. Just a reminder about the positioning of the fund. This is exactly the same slide we shared in June, but the concept is that a flexible mandate, excuse me, unlike a risk profile fund, gives the fund manager significant flexibility to vary the asset mix and the asset allocation. We believe that that is the right strategy. Reminder that our technical benchmark is 70% JSE capped SWIX, 15% is the SA listed property index, and then 15%, which is STEFI, which is really the short end of the yield curve. But our real objective over the long term is to accumulate wealth to generate real returns, in other words, inflation-beating returns, but to manage the volatility and the downside as much as we possibly can. As we said before, the fund is very much a South Africa-focused fund, and our core philosophy is, like everything we do at Korner Perspective, is essentially value-driven. And then we've got a firm belief that we only include assets when we believe they will add value and make a contribution to the returns. And you will see in a second that we, for example, have effectively no property exposure because we didn't believe over the last few years that they would make that contribution. All right, then just looking to the review to the 31st of December, the asset allocation in terms of the buckets, 74% is in equity, 16% in cash, and these are rounded off obviously, and then bonds and prefs was effectively 10. Just looking at how it compares with the benchmark, as we said, the benchmark is 70% equity, 15 cash, 15 property, so obviously we're running quite significant benchmark tracking risk there. Just for those that have been invested in the fund for some time, I'm sure you would have noticed that for much of the last few years we actually ran fairly significant cash and money market holdings and income funds. If you go back to December 2019, that was sitting at about, equity was only sitting at about 50%, and effectively the bulk of the money was sitting, or 50% of the money was sitting effectively in cash and money market instruments. We've included income funds in this slide because the income fund allocation was quite deliberate. It was really an attempt to try and lengthen the yield curve or the duration ever so slightly, just to offer a little bit of a yield pickup over cash. You can see our pref shareholding has been fairly consistent over time, and that the bond allocation has steadily grown since 2021. But the important number obviously there for most investors will be equity, that from December 2019 has gone from circa 50% to about 74%. As we said, we're running quite significant benchmark tracking risk here, just looking at our weightings relative to the benchmark. And what we've done here is we've taken the underlying asset allocation per, for example, the holdings in the income funds, and we've allocated to the correct bucket. We are about 3.8% over equity, virtually on track with cash. We are 14.9% under on our property allocation, and quite a significant overweight in bonds and prefs, which most people would argue should probably be in that benchmark. But yeah, we've effectively, as you would no doubt gather, decided to allocate capital to bonds and prefs rather than property. And as you saw in the asset market review, that strategy has generally worked very, very well. Listed property has been an appalling performer. And although bonds and prefs have not been spectacular, our move into bonds, as you saw, was fairly recent. So we managed to avoid the capital declines that came with rising yields. Okay, so the question then would be why the weightings as they are. Overweight equity, I think, was fairly simple. We saw very attractive valuations. We saw compelling PEs and decent earnings growth rates and very attractive discounts to net asset value or underlying. Also, very interestingly, attractive dividend yields. And one of the last slides we'll look at is just the yield on this fund, and you'll see those dividend yields are making a contribution there. Bond and pref shareholdings. I think the rationale is very simply that, as you would have seen in the asset market report, bond yields offer way better returns than the money market, or money market about 8.25%, whereas medium-dated bonds are 11 or maybe even a little bit better than that if you go to, further than 15 years. And then the big bank prefs, they're paying over 80% of prime. We used to hold first-rand prefs as well. We were obviously taken out of those by the bank, but they're still, ABSA and Standard Bank, paying us over 80% of prime, which is well over 9%, with prime where it is a little over 11. The interesting thing is, because we're at 80% of prime, a 1% decline in interest rates, and the prime rate only sees our yield actually fall by 0.8%. The underweight property, we're going to go into it in a little bit more detail, but the bottom line is we still see a lot of challenges in that sector for some time. And then we're cash neutral, really, because we've tilted towards longer dated paper, and that's almost the balancing figure. All right, yield expectations are largely driving those asset allocation decisions. So if you look, for example, I think consensus is that the Reserve Bank will cut interest rates in 2024. We think it'll only realistically happen in the second half of the year. But the bottom line is that if you look at the money market end of the curve, call and 3 months, which we've got there, outlook is for lower yields. We're not sure, maybe 0.75% lower. The potential impact, obviously, is simply that your yields go down. Where if you look in the bond market, in the bond cluster, if you look at 5-year paper there, it's a little bit better than 3-month. We think that those yields will probably remain relatively flat, so there's not going to be too much of an impact. If you look at the 10-year, you can see yields there almost 10%. We think they could very well come off ever so slightly, so probably realistically could look forward to a little bit of capital gain. And then on the 12 and the 20-year, obviously those yields almost 11 and over 12. We would think that those yields will come down, from the higher levels as the whole yield curve kind of ratchets down and the slope is not too steep. So we would see reasonable capital gain prospects in sort of the 12 to 15-year area, and in the 20-year area, probably quite significant capital gains possible. All right, then looking at equity, the current yield on the all shares is actually an incredible 4.7%. We believe that yields will be higher, and that's true on the high yielding bucket and on the low yielding bucket, as you can see there. And we would say that there's reasonably good prospects for reasonable capital gain if we look over a year or 3 view. And then big bank prefs, current yield circa 9.2%. Outlook obviously is for lower rates, although, as I said, those rates are not going to fall quite as fast as call, or by as much. And the potential impact, we think, is one of capital gain, driven mainly by the fact that we believe the big banks will actually look to exit the listed prefs because they really become quite expensive debt. And then finally, listed property yield is around 10% across the bigger companies. We think the yields will be steady, maybe slightly lower, and the potential outlook is pretty uncertain at the moment. All right, so I think the property bulls would probably want the answers to the question about why we're still so underweight in listed property, and the answers are very simple, summarized in this slide, which we thought was a fairly good reflection of what an e-commerce hub might look like. So obviously, as asset prices have come down, share prices have come down. It's had the effect of increasing yield somewhat, but we believe that the challenges remain. We believe that the high occupancy rates, if we look at among the big 4 or 5 that we're going to briefly discuss here today, you're sitting around 97, 98% occupancy rate. So that's really not much of a lever that can be pulled If anything, we think that might actually create a little bit of vulnerability. We believe that e-commerce particularly, but also COVID, structurally changed the commercial property world. We all know companies who've moved to, I think, what's commonly known as a hybrid model now, where people come in for a few days a week, and clearly e-commerce is becoming a very, very powerful force. So less demand for retail space. Of course, listed property is very exposed to load shedding on a number of levels. Firstly, they have to invest in backup power. Secondly, when we have serious stages 5 and 6, for example, a lot of malls are, for all practical purposes, shut. Where they're not shut, very few of those stores are operating. And of course, then also load shedding has quite an impact on retailer sales, which also impacts the rentals received. I think the core view that we have is that we think as leases expire, it's going to become increasingly difficult for landlords to push through increases that compensate them for the higher costs, for example, administered costs. And then finally, debt levels remain high. If you're targeting 35%, a lot are there, or maybe 38, 40%. And of course, the problem is that when you're wanting to offload assets, everybody's in the same position. So although you would argue that, a 40, 50% decline in share prices would argue for some allocation, we feel that the challenges really do remain. So this graph illustrates the distributions of a few of the bigger property counters over a significant period of time. Brazilian's missing here simply because the data was a little bit squonk. We had 2011 and then 2022, but we illustrating Growth Point, Redefine, Hyprop, Fortress, and these are, let's say, sizable companies in their own right. I think the key thing here for us is that, from sort of 2018, 2019, distributions have been on their way down. They're not rapidly recovering, which is what I think a lot of property bulls might expect. And in fact, if you look from sort of 23 to 24, 25, a lot of these distributions are actually still going down. So, in our view, those challenges we spoke of in the previous slide are going to ultimately hit distributions, and it's not sensible for us to buy a 10% distribution and those distributions fall and that 10 becomes 9.5 or 9, because really there's no compensation for inflation. So then moving on to the equity bucket, again a slide we largely shared last time around. The fund remains very exposed to financials. We've got almost no resource exposure, and we'll explain that in a second. We've got a significant allocation to what we call net asset value plays, so kind of investment holding companies and underlying NAV stories. We've got a reasonable but not excessive allocation to private equity plays. Our EPS plays, EPS growth plays, and PEs are all, we believe, sensible. And in fact, you'll see a little later we've actually sold those where we felt the multiples were excessive for the units of growth we were getting. If you look, our portfolio very, very differently positioned to any sort of sensible benchmark. We retained a significant, but not over the top, allocation to mid and small caps, and then as you'll see, the portfolio is fairly equally weighted. Speaking of which, if you have a look here, you'll see a lot of companies or a lot of shares that we hold around 5, 6, 7, maybe up to about 8 or so % on average. You can see in the 6-7% range, you've got ABSA, ARC, Aspen slightly bigger than that, Ethos, CUP, Naspers, Old Mutual, Remgro, TFG. So, the big holdings, let's say the likes of Standard Bank and Aspen, not dwarfing, so a reasonably well-balanced portfolio, but relatively well concentrated. Also not a big tail, as you can see, small holdings there representing a fairly limited 3%. Our benchmark is the SWIX. You'll see that that those companies that have got red text are effectively top 40 constituents that we have no exposure to currently. And if you look there, it's Anglo, Goldfields, Richmond, Capitec, MTN, Midcorp. Obviously, we have a fairly small exposure to FirstRand that we obtained through the Remgro corporate action and unbundling. But yeah, then you can see some of the other top 40 holdings in the top 20, AB, InBev, Nedbank, Anglo Gold, Sanlam, ShopRite, all missing. So clearly our portfolio very differently positioned to the market. What we wanted to illustrate with this slide is effectively how the equity bucket, and we're expressing the holdings here as a percentage of the total fund rather than the equity bucket, how it's morphed or evolved over the last 5 years, and all of these obviously to December. So if you look back at 2019, Discovery, Raynet, Standard Bank, ABSA, Aspen were our big holdings, and you could see Discovery a fairly consistent holding, and then in 2022, 2023, we reduced that in such that at the end of 2023 we're out of Discovery completely. So effectively our single biggest holding in the portfolio in 2019 December is no longer there. Also, you'll see ShopRite went from 2019 about 3% of the portfolio. It was sold down, it got to a high of about 4% if memory serves, and we've exited that completely. You'll see in a second why. And again, so Standard Bank has always been in the top 5 holdings, but it's now the biggest holding by some order. Aspen equally, it's almost doubled in weighting, as has ABSA moved up quite significantly. Yeah, Naspers was a fairly nominal 2.8%. So I think just a couple of the newer acquisitions there, you can see ARC came in 2021, Fushini Group came in the last 2 years, and Old Mutual came in pretty much in the last year. And then CUP has been there for about 2 years. So I think the key message here is that the portfolio has actually changed quite a bit over the last 5 years, and probably quite a bit more than a lot of private client segregated portfolios would have changed. This chart tries to summarize, the changes. The green ones are effectively assets that are now in the top 10, being ARC, Fushini, Old Mutual, Remgro, and CUP. So those are new entrants to the portfolio and to the top 10. And then the sort of orangey color there are companies that we've either sold out of completely, or we left with a very residual position, so that it's no longer a top 10 holding. And as you can see there, ShopRite, Discovery, and Grand Parade have been exited completely. I think a lot of people might be a little bit alarmed or concerned because there's a fair amount of small cap exposure. I'm talking here about African Rainbow Capital. It's small, it's not really small, it's a good 6 or so billion rand NAV, market cap. But we just thought we'd discuss the merits of it because it's probably not familiar to a lot of people. So what we're trying to illustrate here is that simply because a company has a small market capitalization doesn't necessarily make it a risky company or share. So if you look at, for example, African Rainbow Capital, we're saying the assets that the underpin there are good assets. So if you look at ARC, for example, there's Time Bank, Time Global, as well as some a fairly significant holding in Rain, and a very interesting financial services portfolio. But interestingly, the anchor shareholders, which is ARC Pty, the PIC, UBI, Buntu, for example, all representing over 60%. So although it's small, it's got a very, very solid anchor shareholder base. If you look at Bell Equipment, for example, very, very strong operations and trading at a sizable discount to net asset value. AJ Bell and Company, effectively the family, holding more than 70%. You look at Ethos, we believe very, very good assets. We keep singing its praises. Very attractive discount at these levels, and we believe the realizations could provide an underpin. Anchor shareholders, really management, a few retirement funds, and institutions representing over 20%. City Lodge, we think it's a good hotel operation with a massive property underpin. In fact, if you put a realistic value on City Lodge, it's probably trading at about a 70% discount to NAV. There's around 40% anchor shareholders between the Enderley family and a few institutions. Argent, you've got strong operations, you've got asset value, including cash, and a decent debtors book, underpinned by 50% anchor shareholders, including Morgan Stanley Management and a couple of group companies who've been doing buybacks. And then finally, just another one, York Timber, the underpin, obviously trees in the ground, and the operational outlook as they move towards a longer harvesting period. Anchor shareholders there, effectively A Squared Partners, A2 Partners, and the IDC accounting for over 50%. So what I'm trying to illustrate here is that, these businesses, although they are small, they have strong support from anchor shareholders, often family or connected persons, and all of these actually have strong balance sheets and a compelling story. So simply being, a billion, 2 billion rand market cap, as opposed to a 40 billion rand market cap, we don't believe it automatically makes it risky. And this graphic is very similar to what we showed in June, which really on the x-axis illustrates the PE multiple, where obviously left is good, and the y-axis illustrates the two-year average earnings per share growth. Sometimes they're 3 years when we've already had a year in that's passed. As you can see, a lot of these companies are sort of 10 or slightly over PEs or slightly below, and solid earnings per share growth. So, I mean, the poster child here would be something like Standard Bank that's sitting on a forward of about 7 PE and forecast to give you around 15% over 2 financial years. ABSA's earnings growth rate has come down, but still over 10%. You can see the likes of Aspen over 15% with a PE just a little over 10. A company like TFG, obviously load shedding and a couple of things have trimmed the earnings growth rates, but we're still very, very comfortable. So the bottom line is, when you look at the PE multiples and the earnings growth you're getting from the earnings plays, let's call them, we see a lot of value. So we just discussed where we invested in companies that we're essentially buying the earnings growth story. So it's kind of a relative PE, relative earnings growth story. What we're also illustrating here is quite a lot of net asset value plays. If you look, they are the ones in bold, and those are effectively largely investment holding entities. So you've got ARC Investments, Ethos, Raynet and Remgro as the classic investment holding vehicles. But we also see the likes of Argent, for example, and Naspers as NAV plays as well. In fact, you could lump quite a few others into that bucket. So the point is that we believe the fund, the equity component, is fairly well balanced between traditional PE valuation-driven hypothesis and net asset value. We believe that investment holding companies, investment entities, offer considerable upside. And the reason for that is we like the underlying assets. So I don't want to go through it in too much detail. We did discuss this in June, and I think many of you are familiar with them. But if you look at African Rainbow Capital as an example, investments in Time Bank, Rain, Time Global, discount to NAV around the 50% mark. And the possible catalyst there, obviously the operations, you've seen Time Bank turn positive. We believe Rain is trading very, very well and is disrupting the telecoms industry. But we think Time Global as well, with their expansion into Southeast Asia, could be quite an interesting play. But of course, also there, importantly, is buybacks. All of the companies on this slide and in a few of the other slides also have the added potential catalyst in the form of corporate action. We have heard management of ARC talk about the excessive discount and the debate about whether it's relevant to remain listed. Then Ethos Capital, you've got some amazing assets like Optasia in there. We think Premier is pretty decent. Gamma Tech and Batiste, for example, also good businesses. Again, discount to NAV around the 50% mark. And we believe, operational performance is almost enough to unlock this. You've seen phenomenal performances out of Optasia with approaching 500 million underlying MNO clients. But also we think that the realizations, as we've seen in that portfolio, so in other words, them exiting some of their PE portfolio as well as share buybacks, we believe could provide a catalyst for our performance. In the case of Remgro, as we've discussed before, I think is less of a listed play, having delisted Distel and Mediclinic and obviously distributed FirstRand, or the bulk of them. We think Distel 2.0 is a very exciting business. We're very, very well positioned, better than the old Distel, which we were actually invested in on behalf of clients for a long time. Discount there circa 35%. We think the operational performance, driven probably more large part by Mediclinic, could drive the NAV, but also we expect more buybacks as that portfolio is largely settled and there's probably enough cash flow and not a lot of new entities drawing capital. Raynet obviously is more of a pension insurance corporation, less of a BAT story. Discount, last time I checked, was about 30%, slightly over. Obviously a revaluation, and particularly if you think about who is invested into pension insurance corporation, a few sovereign funds from the Middle East, for example. So, you could very well find somebody taking the view that that discount is a very attractive way of bulking up a holding. So don't be surprised, excuse me, by the possibility of corporate action there. But also we think buybacks are quite possible because I think the Ruperts have also expressed some frustration with the discounts. And then obviously Naspers and Prosus, it's mainly Tencent as the underlying. Discounts to NAV vary depending on the entity, but let's call it around 30 to 40%. We think the possible catalyst, obviously Tencent performance as it itself migrates its model, but obviously also buybacks, particularly from what we've been seeing almost on a daily basis in terms of the reported buybacks. So we can, without being bright-eyed and bushy-tailed and overly optimistic, we can realistically see a world where companies like Ethos and African Rainbow Capital's discounts shrink from say 50% to 35%. If you've got a 5% over the next few years, in addition to strong operational performance translating into NAV growth, we believe there's a lot of upside with fairly limited downside in the five or six counters on this slide. All right, then moving on to possible corporate action plays, and we spoke in the local portfolio commentary about the fact that the JSE continues to shrink, and although it's sad and it's frustrating, it also creates opportunities. We have, for example, been in OneLogics and we were in Massmart ahead of the delistings. So companies we think are fairly ripe with corporate action. ARC, as we mentioned, management have indicated great frustration with the discount. Argent, we think, is really ripe. The actual free float is small. A company like Bell Equipment that trades at, we guess, to be about 50% of NAV, and it's quite easy to use both Argent and Bell Equipment's balance sheet, to engineer a minority buyout. And then quite recently, we actually bought into a new company. It's in January, called New World, which looks cheap, strong cash underpin, and we believe that's also a very, very likely corporate action takeout target. Then also possible corporate action targets include Ethos, City Lodge, CUP, and York Timbers. Obviously, depending on who the and how big the minorities are, could be a fairly big check. But I think companies like City Lodge and CUP, if they got new shareholders with or new owners with different appetite in terms of balance sheet structure, I think those businesses could look very different. So we think there's a real opportunity in these corporate action plays. Although having said that, we would actually rather just hold them and see the market reward them with the kind of ratings they deserve. Okay, then we also have added a few geared market plays. There's a Coronation 91 and Old Mutual. Old Mutual, somewhere between a geared market play and an NAV play. It continues to trade at a fairly substantial discount to its fair value, or its embedded value, or enterprise value, pick a name. Coronation and 91 purer asset management plays, and very simply the rationale is if equity markets take off, two things happen. One, flows into those institutions will probably increase. If you look at 91, obviously lost a fair amount of AUM because of loss of mandates. So those mandates could flow back, but obviously then, if the market goes up 10% and your fees go up, 10 or a little bit more with performance, but your cost base remains the same, it really can power the earnings. So all of these assets we think looking very, very compelling for a recovery in the South African equity market, although obviously 91 particularly has a very, very substantial offshore franchise. Okay, some of the more recent activity, we bought Amplats, and the rationale there was that the lack of profitability and the difficult environment in which South African platinum producers or PGM producers find themselves will eventually result in supply coming offline. Although auto cats represent a significant portion of demand, we also see a world where hydrogen power will account for some. Not every car is going to be powered by electric batteries. I think there will be a mix of fuels and solutions, and it's really just a way of playing that in a fairly cautious way. Of course, Amplats is 75% controlled and owned by Anglo, so if a recap is necessary, you've got a daddy with a deep balance sheet. And then we've also deployed cash across the portfolio. So, over the last year or so, around 20 million rand flowed into the fund. We've generally deployed that across the portfolio, but we've also, as we just said, added a few market proxies like Coronation. We bought and sold some Richemont warrants. So when Richemont got smacked, we felt the sell-off was overdone, and rather than buying the underlying, we bought the options because we felt that gave us a little bit of leverage on the upside, but we were actually quite happy to follow those rights. But we're able to lock in a very nice profit and basically sold all of those, and are now actually trying to reconfigure our next entry point into Richemont. We bought and sold Sasol, and we also bought and sold kind of an at the periphery holding in Naspers, and that's really just been trading the band. That band in Sasol is unfortunately gone, so it's a little bit tricky, but Naspers has been in that sort of 3,000 to 3,400 band, and really just playing with a very small peripheral holding there. As we indicated, we sold out of Discovery and Shoprite completely. In the case of Discovery, we really feel the gears are starting to slip. We think other people are also evolving into the incentive model. You've even seen the likes of Virgin Active, for example, introducing their own incentive schemes. So they're no longer unique. And also we feel that some of the other businesses like the bank are just taking too long to reach break even. And generally we feel that they're quite vulnerable to sort of the immigration wave and the affordability issue, particularly on life insurance. We continue to add small caps, the likes of CUP and Bell and City Lodge. We added to TFGs, as you saw, it's become a top 10 holding. And then when I say we played, we held OneLogics and Massmart ahead of the we just felt that those were going to be delisted, and both of those proved correct. In resources, and the short answer is in that graph there, which shows you the resources index over 20 years. And as you can see, that index is back at the level it was in the beginning of 2007, 2010, 2014, give or take, 2020, 21. So if you have to be brutally honest, the resources index is not a great performer. It's also very, very volatile. So you can see from 20,000 up to 80,000, back to 30,000, back to 60,000. So very, very volatile. And generally you want to be buying these things when the outlook is improving, when the multiples are high and the outlook is for higher commodity prices and more profitability. Whereas right now, if you look at what happened to De Beers, for example, and in the platinum sector, we don't feel the timing is perfect there. And as we illustrated in the asset market report and the local portfolio report, if you look basic materials on a 1, 3, 6 month view, a 1 year view, and even a 3 year view, significantly underperformed the all share. It's outperformed on a 5 year view simply because that's obviously capturing some of the weakness in resources. But generally, as we're illustrating there, with the index back at where it was in 2014, it tells you that it truthfully is about being in resources for a season and not being permanently exposed to them, with a possible exception there being BHP Billiton. It is, however, important to say that, with resources having underperformed as much as they have, and certain commodities like copper and iron ore looking solid, and in some cases ongoing, supply issues and potential deficits in some of those sort of leading indicator commodities, we are a lot more interested in the resources sector than we have been for some time. So there's a fairly high probability that in the next 6 months we will look to increase our resources exposure, but on a fairly focused way, sorry. All right, very quickly, just looking to the minimum disclosure document. The top graph there is the performance over some 5 years. Obviously, we've captured all sorts of things like Ukrainian war invasions and a COVID season. If you look over the 1 year, the fund did about 10.7% for the year to 31 December, 3 and a bit of which would have been in the form of yield, versus a benchmark, which is the 70-15-15 in equity, property, and STEFI. We outperformed that, trailing the ASISA category. And as we said before, the ASISA category is a mishmash of strategies and funds. So it's really not sensible, we don't believe, to measure ourselves against that ASISA category, because it can be anything from income funds through to property, medium equity, you name it. So we kind of ignore the ASISA category. We're more interested in the benchmark, but even there, we're not terribly fussed by benchmark performance. But you can see on a 1 and a 3 year view, performance has picked up quite nicely, and we believe it is actually going to do considerably better than the benchmark over the coming period. And we also believe that it'll probably do better than the ASISA category, for what it's worth, simply because a fair amount of the ASISA category would benefit from rising interest rates, and as we've discussed previously, we believe that ship has sailed. So I think the other important thing, as we said, obviously we've got a benchmark and we measure ourselves against that, but more important for us is just growing wealth and doing it in a responsible way, and obviously downside risk management is an important part of that. This illustrates some of the volatility. You can see there on a 1 year view, our standard deviation was 11.85 versus a benchmark of 13.3. and an even bigger gap if you look over 3 years. So effectively, we're delivering benchmark type performance with lower drawdowns and volatility. And if you look there on the maximum drawdown over a 3-year, 7.3 versus 10.8 on the benchmark. So downside management is important to us, and we are confident that this fund is well positioned to capture the upside while not being too exposed to the downside that maybe the benchmark might experience, courtesy of the way those benchmark indices are put together. Very quickly, just to show the total investment charge, so in other words, what investors actually pay in total. You can see from March 2019, when the fund was small and was kind of forced to hold, a lot of income funds, etc. That TIC has come down very nicely to 1.45 in September, and we believe it will fall further. So that's really the benefit of scale, and obviously we've also tilted away from some higher fee funds towards ETFs and direct holdings. As I said, distributions probably account for a little over 3% of that 10.7 over a 1-year view. And our view is very simply, if you're targeting 10%, for example, which is not, a number necessarily, it's just an illustration. If you can get 3.3 of that 10, so 33% in the form of a fairly predictable yield, we believe you're doing reasonably well. So the distributions are solid, and increasingly more of that's coming from yield, and we think that that yield will actually increase over the next year or so. Very quickly on the funds, and that the mix is appropriate. There's some debate, as we have sown in a couple of weeks' time, about government debt and fiscal prudence, but we believe that that's more than discounted into the bond market at this stage, and that we're locking in both yield and the potential for capital upside in, for example, our bond exposure. We have confidence in the equity bucket, not out of arrogance, but because we believe it's well positioned relative to what is quite an eclectic benchmark. We think that that portfolio of equities can do well, both in absolute terms and relative to its benchmark. We also believe, frankly, that equity portfolio, because of the big discounts and the solid fundamentals and good business mix, that there's considerably more upside to a lot of those assets than is to the downside. And although we remain rooted in our core philosophy of patience and value-driven philosophies, as we've illustrated, we were very overweight cash and we went bonds, we underweight resources, so we're not afraid to express ourselves, and we will adjust as we see necessary. So that's it. I think the only thing left to say is to the investors in the fund, thank you very much for the support. We hope that this has proven valuable to you, and we thank you for your ongoing support, and we look forward to generating better returns over the next year or so. Thank you.